When you walk into a new MGA for the first time and look, let's say, under the hood, what do you typically find operationally?
One is underwriting integrity. Do they actually truly understand their product? Distribution, everything goes back to distribution. Do they understand their distribution, why their distribution goes to them as an MGA or MGU? And then thirdly, what does their data and reporting infrastructure look like?
If you were starting a new MGA right now from scratch, what would you build first, and what would that infrastructure look like from day one?
I would really think about what my data schema is. How am I capturing exposure and experience information? Where am I getting third-party data from? And then building on top of that, reporting layer.
What's the one thing you believe the industry needs to stop doing, and one thing that they need to start doing to actually move forward?
Start making kind of technology investment decisions that are going to compound based on operational evidence, right? And looking again, going back to that fundamental data layer rather than like vendor demos.
Hi, everybody. Welcome to Inside Delegated Authority. And today's guest is Joe Zuk. Joe has spent over 22 years moving across nearly every layer of the insurance value chain, from the reinsurance broken desks at Willis Re and Lockton to underwriting facultative property at Paris Re, to running commercial and property divisions at Atlas General, to leading corporate development and strategy at Orchid Insurance. Today, he's an operating partner at Altamont Capital Partners, where he evaluates, acquires, and builds insurance businesses with a partial focus on middle market MGAs, service companies, and distribution platforms. What makes Joe different from most PE operators you'll hear from is that he's actually sat in the seats. He's brokered treaties, built programs from scratch, led P&Ls, integrated acquisitions, and now he's the one deciding where capital goes and how to create value after the check clears. He's also become one of the more vocal voices in the industry on why AI's real impact isn't in flashy demos. It's in the operational groundwork that nobody wants to talk about. Today, we're going to get into what he's learned moving between those roles, why the best MGAs treat soft markets as an opportunity, and what private equity actually looks when it walks into an underwriting operation. Let's get into it. Welcome, Joe.
Thank you, Daniel. Pleasure to be here today. I really appreciate the opportunity to be on the pod.
Now, amazing. To kick us off, Joe, you've touched nearly every link in the insurance value chain, underwriting, GA operations, corporate development, and now private equity. Before we get into big stuff, how do you actually describe what your day-to-day as an operating partner at Altamont is?
It's a great question, Daniel, one I get asked quite a bit. The honest answer is I run 3 jobs simultaneously here. At Altamont, I'm the person who sits between the capital and the operating companies. I often like to say I'm a force multiplier and kind of lead the charge on many things. My job is to make sure that the thesis we brought in doesn't evaporate because nobody fixed the problems we knew existed on day one. Concurrently, sometimes I take functional roles and then recruit and hire myself out of those roles at the various portfolio companies to jumpstart or make sure that we're continuing the path of rapid value creation. Across each one of our portfolio companies, I hold various board seats and I've helped or build, acquire add-ons or launch new initiatives and new projects. Day to day, that means, my day can vary quite wildly. So anything from board work to carrier calls to corporate development to recruiting to just functional matters in the afternoon. There's no real clean separation, but it's a lot of fun and it makes it quite stimulating and quite exciting for me.
Now, amazing, Joe. Thanks for sharing. And you have had a great career at several great companies like Willis Re, Lockton Re, Paris Re, then into MGA operations and leadership. What was the hardest transition between those roles? And what surprised you about how differently each side operates in the value chain?
Really good question. For me, probably the hardest move was moving from reinsurance brokering to reinsurance underwriting. As a broker, you're often translating, selling, you understand the risk, you understand the capital, but the pen still belongs to someone else. Once you're actually binding millions of dollars of limit, you're actually, you're not optimizing for a placement. You're actually taking and putting the company's real capital on the line. Early on, that was quite scary for me and so forth. And, the time horizon certainly shifts, but it gives you, I think, a really good understanding of risk and risk capital, and then also shapes kind of the forward-looking lens, if you move back to broking or you're an operator on the MGA side and so forth. So that was probably the hardest transition for me.
That's a great point. And for anybody thinking about the transition, what would you suggest to take into account, how to plan? Like everybody talks about the first 90 days.
Yeah, really good question, right? I think, as much as anything, two different psychological postures. Brokers understand risk, writers have to own the risk. I think being able to put yourself on both sides of that table, and at the same time, underwriters can't forget that they have to sell the capital, right? It is a product that they're selling. But having that kind of 360 perspective, I think helps anybody kind of move from either broking to underwriting or underwriting to broking, which is a bit less common.
Yeah, I know on the broking side, what makes it so hard to understand each risk that used to fall on your desk?
Yeah, I mean, I think from the broking side, what does it mean to really understand the risk? A few things. One, you've got to understand the underlying exposures, gather the experience information, but then really understand rate adequacy, coverage specifications. And then I think the macro matters as well, right? It's not what that risk is here and now, present day, and the backward looking view, but what the forward looking view is as well. That's going to shape either being a better broker or a better underwriter.
Yeah, that's a great point. But nowadays, I would say we have more information that we can consume. Where do you feel,
True.
or how do you feel brokers can do this efficiently with the time constraints that we have?
Well, I mean, obviously it's a good lead up to the use of AI and so forth. So I think there's a couple things, right? AI is a great tool here, the large language models, the hyperscalers, to help consume and summarize large volumes of data quickly. Yourself or myself or others can do, what used to take a half a day now can take literally seconds. A great example is just scrubbing schedule values, right, of a property SOV and then pulling in third-party data. So I think that's one element. The second element is not always relying on computer says yes or computer says no, but, having that macro and that institutional knowledge is critically important. And then the third point here is also just to sense check it, right? Does this actually resonate in the real world or not? I think you can use AI as a tool to expedite things and certainly help with the consumption of just vast amounts of, and myself personally, and often overloaded by just how much there is to consume in terms of data and knowledge and information every day and what gets generated. I think it's a balance, finding that right balance and what is enough to make an adequate decision one way or another.
Yeah, it's perfect is the enemy of great. That's what they say. And on the MGA side, you have to differentiate your capital. How do you feel those underwriters can position themselves to win the businesses that brokers are sending their way?
Good question. So I think that it breaks down in a couple components. One is providing a really good experience as an MGA to your distribution and truly understanding your distribution, right? What does that mean? You win on service, you win on product, and thirdly, you win on responsiveness. And that experience, whether it's through an electronic channel, in a system or email or meeting distribution in, an omni-channel environment in which they want to be able to interact with you, says a lot about how you're going to, win buying and win the business over time. At the same time, you have to balance consistency. And what do brokers always look for? They look for consistency, right? And I think that means stability and capacity, underwriting integrity, and a product set that doesn't change a lot year over year. Those are really all important things for an MGA or MGU when interfacing with brokers of distribution.
And you've evaluated and invested in a lot of MGAs through Altamont. When you walk into a new MGA for the first time and look, let's say, under the hood, what do you typically find operationally? What does the before picture usually look like?
Good question. What do I look for? I look for a couple key things. One is underwriting integrity. Do they actually truly understand their product? Distribution, everything goes back to distribution. Do they understand their distribution, why their distribution goes to them as an MG or MGU? And then thirdly, what does their data and reporting infrastructure look like? I think that's so important. Can they provide reporting data? Is it clean? Is it orderly? Is it consistent? That says a lot about their operational hygiene.
Yeah, and then I'm pretty sure you got a sense with the multiple MGs you have invested and also evaluated. Do you feel with those MGAs that, let's say you say they're gonna be a winner versus the ones that are gonna be stalled, or there's not gonna be a lot of, let's say, optimization or profit on that end? How do those look like, and how do you find them?
Well, good question. A couple things. One, I think is, it depends if you're buying or building. If you're building, it's certainly that entrepreneurial drive, the resiliency, again, goes back to distribution. Does distribution follow because it's, Joe Zuk, or does it follow because, it was AIG on the door? I think there's a couple key factors. Do they have an operational understanding of Modica? If you're buying or investing in an MGA, it goes back to those aforementioned points I mentioned, but also what has been their track record with their carriers, what has been their underwriting profitability, and what is the depth in their management team for that next round. All of those components come together here to say whether or not that's going to be a likely good outcome or not for the investor.
Yeah, those are great points. And I would say everything starts with the submission. You get the submission from the broker. But can you walk me through how is that process actually look like for a typical MGA that you've worked with, from the moment the broker sends that first submission to the underwriter actually making a decision, and what happens in between?
Yeah. Oh, good question. Well, I got a typical MJ or MGU. No, not the good ones, but the typical ones. The submission arrives generally via email, right? It gets forwarded. It lives in somebody's inbox. Back in the day, we used to print and put it on a stack, and you go grab it off of a stack. If the underwriter is busy, right? If it comes in on a Friday afternoon, it might not get touched till Monday or Tuesday. By then, maybe the broker's already gone or got it placed elsewhere. I think, the average quote to submission turnaround for a mid-market MGA is still measured in days when it needs to be measured literally in hours, if not minutes. And where retail brokers or wholesale brokers can access a dozen markets, and, days is, going to put you at a competitive disadvantage. I like to say the submission process at most MGAs still is like a fax machine with a logo on it. And it goes back to what's that experience for that broker with that MGA is, can they go through and straight through quote process? Do they bounce out immediately to some, that human element? I think those things are really important.
Why do you feel the process is still like a fax machine with a logo?
Well, so much of it is still email driven, right? And it's received the submission. Okay, it's in the queue. I'm a broker. I don't know where it stands. Am I going to get a response? Am I going to decline? Sometimes the underwriter's like, well, the easiest thing is just to decline. And the brokers work so hard to get that piece of business in the door. It can be very disappointing. So that's why I use that analogy.
No, that's fair. Which of these parts of that operational process that they do you feel could be improved or automated, or uh, made in a better and smoother way?
I think a number of things, right? Certainly that ingestion, the ability to pull third-party data to validate and, giving progress and kind of feedback, whether that's electronically and visually, and responsiveness and acknowledgement to the broker goes a very, very long way. And then watching, where they drop off, just like anything in retail, right? In terms of consumer, similar goes for insurance, right? If we see why somebody's dropping off, we'll really understand what is it about that process. If they're online quoting, if they're submitting or something that causes them to kind of move on from you. I think that's going to give you a lot of insight as to what's working and what doesn't, and where you can improve your process.
And hopefully we can move from coding in days or bind to coding in minutes. What do you feel is keeping away this MGA from trying or improving or giving a chance to this new technology?
I think, well, it's a number of things. It's an investment in time. It's a cultural change. There is technology, resource, bandwidth. Two, insurance moves slowly and people get very stuck in their ways. And then thirdly, it's also kind of experimenting and putting that energy and effort in, and not everything's going to work. So, folks default to what they're comfortable with, which is, Outlook and email.
And then we have seen companies preaching that they can take away the human in the loop, human in the process. I would say trust is the one thing that technology can't automate. In a
Correct.
world where we're talking more about or hear more about AI replacing underwriters, where do you draw the line between what should be automated and what should be still done by a human?
Really good. I mean, you said trust, right? So anything that is judgment or trust related or affirmation or even kind of deep domain expertise should be done by a human, right? That human judgment, that lateral, that contextual awareness, I think is still humans outpace AI on. But if it's simply kind of to the top of the pod that we talked about, the organizational data consumption, anything that's kind of routine or rote or repetitive, that completely should be done by AI and technology.
Yeah, and one of the three criteria that you mentioned during the due diligence of an MGA acquisition was the ability to do reporting. How much that whole piece, let's say data and reporting infrastructure, factors in that valuation? And if you have ever walked away from a deal because you were not able to see their information and analyze it.
Every time. Yeah. If I can't get the data information, it's not worth my time to move on.
And how would you suggest those MGAs that sometimes they believe that my data is too messy for AI, my data is too messy to actually build reporting, or we're not ready for technology? Like you have seen this multiple times. Is this something that it's actually true, or is just an excuse to avoid change, avoid an acquisition, avoid growth?
Well, I mean, I think it's probably a bit of both. It's an excuse, it's laziness, and it's frankly incompetency, right? And that may have worked in a pre-AI age and it may work for a little while longer, but pretty quickly those folks are going to lose their capacity. They're going to get armed against. Um, they're going to see any value of their business quickly evaporate and erode. I think it's going to be as simple as that, and it's going to come really, really fast.
And distribution, I would say, and distribution comes with people. What would you suggest to an MGA that you were not able to do the reporting analysis on how to build that reporting foundation to actually be prepared for change and to scale?
No, it's a good question. Well, I think everything on the first principles basis, right, is building the foundational data lake, the information that goes into that and understanding the components. And I always think about things in kind of modular blocks or tasks. So, end to end, to use the old Schoolhouse Rocks analogy from the 70s, where he's cartoon, how a bill becomes a law. How does an insured, an application, a submission become a policy, and what is that full life cycle? Understanding each and every component and what data element you're capturing and organizing that, building that in a foundational data lake and good data hygiene, good dictionary, all that kind of cleanliness, takes work, but it pays immense dividends down the road here. But it's got to start at that first principles basis.
No, that's fair. To get a sense on how much value is created when you have this data lake foundation in place, how big of a change can an MGA see from not having reporting, not having that structure to actually having it, and how does that value reflect in their valuation?
Well, they get insights into the book, they get insights into their expenses, their operational efficiency. Then they can start to really leverage LLMs and AI on their and optimize, right, their business. What that uplift translates, I mean, I think depends wildly, but I've seen things that have increased by, two or threefold quite easily there just by, those best practices.
No, that's amazing. So gotta do it, I would say. And then you go the A path. Great MGAs, you start to acquire. When you bring those two, three, four, multiple MGAs together, what usually is the hardest part to integrate? The systems, the people, the processes, and I'm pretty sure sometimes you have to do fixes. How do you do that, and how does that play out?
Yeah, I mean, I would say it's the people element almost every time. Systems are fixable, processes are rewritable, but when you put multiple underwriting cultures in the same room and you tell them, "Hey, become one team," you're kind of asking for changes in habits and, what's defined them each and, professionally. The technical integration, it's not easy and there is a project plan, but it's easy. It can be done, right? The cultural integration tends to be a negotiation. Where I've seen integrations fail has been because, people assume like, oh, we'll just get the systems and the systems don't work if the people aren't working together either, right? It never does. So yes, you can migrate and, system migration is immensely important, but you've got to get the cultural piece right and the people working together. Um, if anyone tells you otherwise, then they actually probably haven't done it.
Yeah, what we say is that step by step to do that integration in the best possible way.
Well, I mean, I think first off is making sure that everybody feels welcome and aligned with the vision, and that they are integrated into understanding where and that communication is clear and consistent from leadership and management and the capital. And then if they're not, then I think you have to make some tough decisions, right? And then where you augment the team on that, and then you set forth, and it becomes down to ruthless execution.
Yeah, I would say action beats most of the other tasks that you can do. The other thing that I've seen is soft markets. I feel we're kind of in a soft market right now, and a lot of M&A activity starts to appear. What do you feel usually happens when this, let's say, market is positioned to favor M&As? I've seen most teams like do the opposite. They coast. What do you think that happened, and what do you think people should do in this type of market right now?
Yeah, well, I mean, in a soft market, everybody looks for top line growth, right? So, fixing things it's hard and painful. And so an easy thing is to buy to drive top line growth. We are in a soft market here and, everything kind of flows until the tide goes out and the market changes. I think soft markets are good opportunities to build, fix your infrastructure and train underwriting, right? Deeply about your product program set, clean up the data like we talked about. But also it's a good time to build as well, but build on a patient level. And then when the market turns, I think you're going to set yourself up for good success down the road.
So we have top line revenue, your processes, the ones you can, let's say, build for future growth. When you hear an MGA say, I'll just build this in house with all these new tools out there that you could basically do everything and anything, whether it's a data system, an AI tool, or a submission platform, what goes through your mind that build versus buying? I'm pretty sure you have seen the both sides of building and buying. What are your thoughts there?
I have a couple things. I mean, one, skepticism, right? It's not that I'm reflectively, opposition of it, right? I think there are certainly very good legitimate cases for building in-house, but I think people underestimate what that means, the resource, the time, the expense, the distraction factor, who's going to actually own the roadmap. And, is that the core competency of your business, right? Especially when there are so many people and the cost of compute and the cost of technology continues to go down and that acceleration is ever faster. Um, I think you need to think about what do you really want to own in house and why. And certainly it goes back to the data. I think those pieces of it, or maybe it's a piece that, is really front facing with your distribution that you really want to own. Great. Is on that, build that in house because it supports and augments your core business. Everything else, I would go modular and find the best in class vendors and make sure that you have good integration and connectivity and that good foundation and fundamental business to absorb and capture the data and be able to kind of move on from a vendor who becomes irresponsive or just doesn't keep up or you find something better. That way you get the best of a worldwide, global access of technology and software and tooling versus being reliant on your own little closed environment, unless your business is to be in the technology business.
Yeah, that's I would say a theme that I've started to see. MGAs that were underwriting then become insurtechs, or insurtechs that were only selling software. Then from one moment to another, they become underwriting company, an MGA and MGU. From your
Correct.
experience advising both MGAs, MGUs, and insurtech startups, and you have seen also big insurance companies deploying capital into developing system. From that point of view that you have, what's the most expensive mistake you see these teams, either an MGA building technology to then become insurtech or the other way around, do when they are trying to build technology and increase their growth and operations?
Scaling headcount before scaling process. I mean, I think the instinct is when volume grows is to hire. But if the underlying workflow is broken, right? Every new hire just inherits something that's already broken, and it gets amplified, right? And you compound. I've seen many folks who have tripled their staff, but see their operational quality decline, right? Because the work became more fragmented, not less. I think the correct sequence here, Daniel, is like define the process, automate what can be automated, then hire for that residual capacity gap, right? But very few people struggle with that order and with that frame of thinking. I think you can try to hire your way out of a process problem. That is often the most expensive mistakes you can make in insurance operations. It feels productive, but it actually ends up being kind of counterproductive, and then you quickly can find yourself an expense problem, and then you try to reduce that, and then it's a little bit of a spiral.
And I would say we're very optimistic people that we start a project and it's going to be successful. When do you feel a company should say, okay, I was building this. This was a great idea, but the execution is not there. The expectations were not aligned. How do you feel a company an MGA can analyze to say, it's time to kill this project? It's not going to be, and I should be looking outside for a buy option for me.
Well, I mean, pretty quickly, right? I think if the project is taking on a life of itself or distracting from, core in-house here, right? And if you're spending those dollars on building and maintaining technology versus getting better at the thing that actually differentiates you, you should kill that quickly and go outside and get it solved.
And you've embraced PE's evolution from capital allocation to capability creation. 5 years from now, what do you believe will separate the MGAs that thrive from the ones that unfortunately didn't make it? And how much of that is going to be technology infrastructure versus pure talent?
Good question. I think the ones that survived the next hard market here, are those that don't have capacity crises, right? Full stop, right? The technical infrastructure, the talent questions, that's always real, right? But they are more kind of second order. I think the first order is when capacity changes here. And if your combined ratio is triple digits, do you have the data to defend your book as to why and the credibility to believe to retain that capacity? Strategies that thrive are going to be built for the future hard market here. And they're not optimizing for today's market, right? They're building for the next market cycle. And I think underwriting integrity and fundamentals is everything.
Yeah, building for the next cycle. I like that thought. If you were starting a new MGA right now from scratch, a sheet of paper, no legacy system, no inherited processes, what would you build first? And what would that infrastructure look like from day one?
Data infrastructure, data architecture. So before I did my first policy or anything, I would really think about what my data schema is. How am I capturing exposure and experience information? Where am I getting third-party data from? And then building on top of that, reporting layer, tech stack, and then focus on the underwriting guidelines, distribution. All that's going to compound, right, on that foundational level. If you don't get that foundational right, it's that data model. If you don't have that correct, you're going to wonder, well, why can't I get that capacity? And maybe you get lucky and do get capacity, right, in this market, right, soft market. But when the market turns or you want that next layer and you can't really report, you're going to have a problem.
Yeah, everything comes to the foundation of knowing your business and being able to navigate it and know where to look. But Joe, you sit in a very unique intersection between capital, operations, and technology. Focus only on insurance. What's the one thing you believe the industry needs to stop doing, and one thing that they need to start doing to actually move forward?
Question. I would stop conflating activity with progress. The industry runs a ton of like conferences and roundtables and all kind. I mean, you could like make a professional business just attending conferences and seemingly being busy. That it doesn't really change anything. I would say start making kind of technology investment decisions that are going to compound based on operational evidence, right? And looking again, going back to that fundamental data layer rather than like vendor demos and saying, this conference and, I call it kind of pilot purgatory, right? And where you actually kind of need to move into production. And then I've watched too many MGAs buy a system that because the demo is impressive, only to discover that the implementation wasn't there. They didn't have this, system integrators, and it bore no resemblance to what the demo was trying to sell. Pilot everything, validate everything, trust nothing, because it hasn't been probably tested and actually utilized in the real world in the actual environment. This is a relationship business, and that is used to earlier in our conversation today to be a reason not to change, right? But that excuse is expiring. I think there's so much knowledge out there to be harvested and garnered and really help in your kind of setup and thinking here that you don't really have an excuse for that anymore.
Yeah, I would say we're in a world that it's more outcome focused than
Correct.
anything else. What are those activities you feel those MGAs should deprioritize, and which ones should they 100% prioritize because it's gonna actually deliver the outcomes that they want and need?
Well, I think there's a lot of kabuki of trying to be active in conferences and saying I'm doing this or doing that, but actually getting nothing really done. I think it's like execution matters, showing that you're building a durable, sustainable business. And then revenue, right? I mean, at the end of the day, we're in the business to build and generate revenue and nice EBITDA. That would be my message.
No, amazing, Joe. Last one, Joe. If every head of underwriting, every MGA operator, and every reinsurance broker listening to this could hear one thing from you, from someone who has been on every side of the business, what would that be?
I would say the window for comfortable evolution is closing here, Daniel. And I think 5 years ago, 6 years ago, you can improve incrementally and stay competitive. Today, that gap is rapidly closing, right, with AI and technology. And those organizations who have invested in operational excellence and data infrastructure, and the ones that have not, is starting to become very apparent. And that gap is becoming measurable and widening each and every day, right? The ones that are behind are not just competing against better run peers, they're competing against new entrants. They're competing against an evolution of technology and AI and an industry that will be pushed along more quickly than it historically ever has been. And that's extremely uncomfortable for a lot of people. You don't get valued on a multiple of EBITDA based on nostalgia, right? Or how things used to work. Yes, relationships are matter. And I do love the fact that insurance is so relationship driven, but the market and the multiples aren't going to care about that longer term. It cares about what you can prove and what you can, tangibly demonstrate. The insurance industry has been a refuge of a spreadsheet for a very long time. The people who figure that out quickly and rely on just the spreadsheet aren't going to figure much else out, and you're going to be left, to the dustbin of history here. That would be my kind of closing message here to the industry is, evolve and adapt and be resilient and durable. If not, I think you might have some challenges ahead here.
Thank you very much, Joe. I really enjoyed that conversation. This was Inside Delegated Authority with Joe Zuk and your host, Daniel. See you next time. Bye.